Welcome to Investors Insights, where today's topic is all about the Fed. Got a big Fed decision going on Wednesday, and the question is, how aggressive are they going to continue to raise? That's going to be the story this week. That's what's going to drive the markets. And last week, we got a higher than expected inflation number. So, Ty, please start off talking about that.
Yeah, so we were expecting basically a 0.1% decrease. We got a 0.1% increase. So I know that doesn't sound like a lot, but when you consider that energy prices were down 5%, thanks to gas prices coming down, which, we're all thankful to see, is a big increase. What's driving it? Food prices, rents, medical services, some operations, services are coming back, but they're coming back at higher prices. The Fed is definitely focused on this number. It was a surprise to the upside, and by upside I mean to the negative. It was hotter than expected. The Fed is going to be watching that and change expectations from maybe 50 basis point hike to probably definitely 75, maybe even a full 100 basis points.
Yeah, and as volatility remains the story, we continue to look back in history to see how market has performed in the past with similar setups. And a chart that continues to interest us is the average stock decline, with the S&P 500 down 18% since January 1st. The average stock has actually declined 25%, which is why active management has been crucial this year. And actually, the average stock is near the -2 standard deviation level, which shows performance different from the average that is often associated with the bounce up. As you can see in this chart, the dotted red line going back to 1980, the market has bounced to the upside numerous times when stocks have fallen like they have this year. As always, no guarantees, but we're watching carefully to see if history repeats itself as we manage through the Federal Reserve aggressively raising rates again this week on Wednesday, with one question being, will the market bounce higher like we've seen before at this level, or remain at the levels that you can see in this chart for an extended period of time like we saw in 1998 through 2002 during that time period? If we can bounce higher at these levels, it will be a good sign. But again, like I said earlier, it's all about the Fed and how the market reacts to the Fed decision. So last week, we had the unexpected higher inflation number. So Adam, talk about the updated technicals as we are showing some weakness after those numbers on Tuesday.
Definitely. And you mentioned it, Bobby. Saw a lot of volatility in the markets last week with the S&P coming in on Friday's close at 3,873. That gives us a new short-term resistance level of 3,900 and new support level of 3,840. Now, it's also important to mention, we talked about that intermediate to long-term support level. Reaching out to the end of the year, we saw the market cross through that at 3,900. Now, that doesn't mean that we're in a bear market by any means. It means that we need to keep a close eye and tracking it over the next couple of weeks and months to see if it holds under there. If it bounces back up, the year-to-date moving day average of the S&P is currently sitting at 4,206. It's really close to our long-term resistance level. So market's going to be important, like you said, Bobby, with the Fed coming up, also midterm elections. So something we want to keep an eye on to see if we can get some momentum back in the markets. Also important to say that, sometimes these pullbacks can create very good buying opportunities as well. So we're going to keep a close eye on the Fed this week and see what these levels look like, come next week and the next following weeks, along with months as well.
Yep. So again, all about the Fed this week. They make their decision Wednesday, middle of the day. So we'll be obviously watching that very carefully here. So as always, if you have questions, please reach out to us. And what is definitely not going to be a dull week in the market. A lot going on. Thanks for watching. See you next week. Thanks.